All right, friends, welcome to session 3 of this Fund of Funds mini series that we're doing about how everything that you need to know, high level view of what you need to start a fund. Really excited to be here with everybody. I'm very happy you're all here, first of all, right? We got people from all over the country and even people in an airport here with us to learn about this today. Excited to have it. So, as always, guys, this is very conversational as I'm going through this. You'll notice that I do get off on a rant sometimes and just start going. But please, if you have a question, either throw it in the chat or feel free to just unmute yourself. I really want this to be conversational, and truthfully, I do a better job when I'm having a conversation than when I'm just presenting. So it actually helps me if you ask questions. We've already covered a lot in the last 2 sessions, the trust factor and, why to start a fund of funds and, what the benefit is. The goal today is to help you master the rules, right? Because, John, that's really awesome red color on you. It actually looks really good, but I don't think you'd look good in an orange jumpsuit, right? And neither would I. Let's be honest, right? This does not look good in an orange jumpsuit. Anyway, and then we're also going to talk about some strategy, right? To help talk the choices that you would need to make to set up your fund to fit your goals, right? So it's really about building an institutional fund that your investors can have faith in. Awesome. And then at the very end, I'm going to let you guys in on a little surprise that's coming up. It's exciting. But before we begin, we always have to do a disclaimer, right? I am not a CPA. I'm not a financial advisor. I'm not an attorney. And I'm definitely not your attorney. So this is just for education. Before you action any of this stuff, be sure and speak to your attorney and make sure that you are doing the right thing. So next, let's talk about our good old friend Reg D. So, you guys, when you put together a fund like this, there's actually multiple laws that you have to pay attention to. And, when we're doing a syndication, everybody's used Reg D before. We're familiar with it, right? But I want to make sure we cover it for anybody that maybe isn't familiar with it or that this is a new concept to. But the first thing to understand is we have to talk about what is a security. A lot of people have been in this business for a long time and they don't understand what the definition of a security is. Well, this actually goes back to a Supreme Court case. You see here from 1946, right? The Howey Foundation was in Orange Grove in Florida. Can't remember the city, but the Supreme Court came out and said there's 4 rules that define what a security is. And it is all based on this Howey Orange Grove deal. And these 4 rules are: if you're making an investment of money in a common enterprise with the expectation of profits solely based on somebody else's efforts, then it's a security. So let's go back and talk about that. Did you invest money? Yes. Is it into a common enterprise, like a pool of people? Yes. Is it, are you expecting money profit back? Yes. And is it solely based on the effort of other people? Yes. Then it's a security, right? And if you're doing a security, you have 2 options. You can either register it and publicly trade it, like on the stock market, which is insane. Nobody here wants to do that. Or you have to have an exemption, right? So is everybody clear on what a security is? Anybody have any questions about that? Do we need to go into examples or anything? Awesome. Okay. So we know what a security is, and we know we don't want to register, so we have to have an exemption, right? So there's a few ways to get an exemption. There's a thing called Reg A, which is basically a light public offering. Nobody does that really in this space. There is also Reg CF, which does happen in this space sometimes, but it's more rare. The thing about that is you have to have a crowdfunding platform that you use. Again, outside of the scope of this, it really isn't a fit for this conversation, but it does exist. I'm going to go out on a limb and say 95% of the funds that we're talking about are either going to be 506B or 506C. So really, there's some things, some nuances here, but the biggest difference between these two is, right, 506B over here on the left, you cannot advertise. 506C on the right, you can advertise. That's the biggest difference and the thing that everybody needs to understand. Why would you choose 506B over 506C if you can advertise in C, but you can't in B? Well, the rules are a little bit easier, and you can take up to 35 non-accredited investors. Now, they have to be what they consider sophisticated investors, and you can make them sophisticated by giving them some education and proving that you know that they have some understanding of the financial markets. But now they don't have to have, right, a net worth of $1 million. They don't have to have an income of $200,000 or more, right? They don't have to be an accredited investor. Up to 35 of those. And the other really cool thing is the people who are accredited in 506B, they can self-certify. They just have to say, hey, Casey, I'm an accredited investor. You don't have to worry about the 35 limit. And that's good enough verification. Now, 506C, as I mentioned, you can advertise, you can take out billboards, you can run Facebook ads, you could put an article in the newspaper if you wanted to. But you can only take accredited investors, and you have to have third-party verification that they qualify as an accredited investor. Big difference. And I want you to understand this because there's a big difference in strategy here, especially when we layer on the next set of laws that we're talking about. This is a very complicated decision that you're going to need some help understanding and making sure that you thought through long-term in how your fund is set up. Okay? So if there's no questions on 506B versus 506C, let's start talking about...
I got a question real quick.
Get it, Casey. Get it.
So, when you're an accredited investor and you're about to invest into something, you said this, that you can just tell them that you're accredited and call it good, but do you have to, can you just say that, or do you have to like show a certificate or something from your CPA saying that you're accredited?
In 506B, it's literally just the honor system.
So, okay, I want to elaborate on that a little bit. If it's just the honor system, what happens if you say that you are accredited and you do invest, but you're actually not? What happens there? Is there any repercussions? What if the deal goes south and you said you're accredited, but you're not? I'm just kind of curious about that whole thing.
So good question, Casey. In fact, we're focused on the fund manager here or the capital raise, the person who's putting it together. And so I'm going to answer your question this way. If you come to me, Casey, and you're going to invest in a 506B deal of mine, I'm going to ask you, are you accredited? And you're going to say the words yes. I'm going to document somehow that on this date, on this time, you said the words to me, you're accredited. And then if something does happen, the deal goes south or whatever, right? I have all of that documentation. Now, in a normal syndication, it's probably not a big deal because the rule says you can have up to 35 non-accredited investors. And the only time that becomes a problem is if you have 36 that are non-accredited, right? But if they've self-certified and they've actually said the words to you, we're accredited, and you're documenting that they're accredited, it's not a big deal for the capital raiser or the fund manager. Does that make sense?
Yeah. Okay.
Got it. Good. Okay. Any other questions on Reg D? Howey Test, any of that? Okay. So you've got to make this decision, friends, but you've also got to make this decision. You've got to know the difference between, why is my computer no? There it is. You got to know the difference between 3C1 and 3C5. Okay, so Reg D is the exemption from the securities exemption. Now we've got to have, when you're doing a fund, a long-term fund with multiple investments, now you've got to have an exemption from the 40s Act, the 1940s Act. So being able to not be a registered investment advisor, basically, right? So a 3C1, now this is a venture capital fund or a passive investment fund. 3C1 is if you're not an operator, first and foremost, right? That's something you got to understand. Everything that goes into a 3C1 fund are going to be passive investments or other securities. You got to know that, okay? So there's some rules. As you can see here, there's a 90, actually, this is a little bit false. There's a 100 investor limit in a 3C1 fund, but you, the fund manager, count as an investor. Okay, so there's a 99 investor limit because of that. Once you get to 99, now what? You basically have to shut down that fund and do something else, right? But it's very flexible. The pro is you can put any kind of asset you want in it. You can put oil and gas, you can put stocks, you can put real estate, you can put literally anything you want in it, businesses. Now, this is something that you've really got to understand down here at the bottom, the integration warning. You cannot run two 3C1 funds at the same exact time with the same strategy. If you do that, the SEC is going to integrate them and they're going to consider it one fund. And if you go past that 99 investor limit, you blow your exemption. And Casey, this is the question that you were really asking. What if you don't follow the rule here? It doesn't really matter if it's 506B or 3C1. When you lose your exemption, now you have to go register as a publicly traded stock. It'll basically shut you down, right? So you got to stay inside of these rules. There are penalties and fines and things like that if you go outside of them. But in short, it just shuts you down. Now, the one thing that I'm not sure on, and
Can
I'm
I ask one
looking
more
for,
question on that?
please, Casey.
So, okay, somebody invests in your deal. They say they're accredited. They're not
Mm-hmm.
accredited. You take their word for it. You keep your notes. But
Yep.
now you have 36 unaccredited investors. The deal is still safe though because you documented that they said they were accredited, but really they weren't. Yes or
Yeah.
no?
Yeah. Okay. I think we're missing something here. In the 506B world, Casey, if you tell me you're accredited in that deal, you're accredited. I don't have to prove it. And if you lied to me, it's on you,
Got it. Okay.
not on
Okay.
me.
I got it.
Now, 506C is in Charlie. I have to get proof. You have to give me a letter from a CPA, an attorney, or licensed financial advisor. Or there are third-party companies that you can go and you pay $50 to, and they'll give you a accredited investor letter. And that letter is good for up to 90 days. Right. So you have to get a new letter every 90 days.
Okay.
In a 506C is in Charlie. Great question.
Great. Thanks.
Now, while we're on that topic, I'm glad you brought that up because that flows right into what I was saying. I actually have a conversation with a securities attorney to get some clarity on some of these things. Because as I mentioned in the very first slide, right, I'm not a securities attorney. So you cannot integrate, right? You cannot run twin 3C1 funds simultaneously to bypass the cap. When I went and looked into that rule a little bit more, it said you cannot have two funds with the same strategy and the same underlying assets. But I know people that have 3C1 and both 506B and 506C. So they are running two funds. Honestly, you guys, right now, I'm not 100% sure if they're following the rule, if they're following that or not. But they literally have a 506B fund and a 506C fund And every time they get a non-accredited investor, they put them in the 506B. That is not advice. I don't know if it's legit, but I know 5 or 6 different people that are doing that. And this is the part I would be concerned about that. As I mentioned, I have a call with an attorney. I'm going to ask him that exact question very soon. Hi, Rebecca.
Senate, I have a question.
Go ahead, Jamie.
So how often are these accounts audited by the Security Administration? Once a year, 5 years, when something comes up?
Yeah, it's when something comes up. So again, this is definitely not advice, but you have to have your own, sense of risk, and I relate it to the speed limit. Okay. Are you somebody that goes exactly the speed limit? Do you go 1 mile an hour under the speed limit to be safe? Do you go 2 or 3 miles an hour over the speed limit? Do you go 5? Right? The times when it matters is when you get in a car wreck or when there's a police officer looking at it. Right? Same type of thing with these rules. No one's going to come and look at this just randomly. There's got to be something to trigger it. Either something really bad happened, somebody lost some money, somebody complained, the deal blew up, there was a lawsuit, right? These rules are not there. I'm not trying to tell you these rules for you to find a way around them. I'm telling you these rules so that if/when you go launch a fund, you know the questions to ask, you know the things to look out for, right? And it's outside of the scope of this to give you every single possible answer in 4 hours. But I want you to know the things that you got to look out for. That makes sense? Good, good. Awesome. Rebecca, it's really good to see you. I'm glad you're here. All right. So I think I've beat up on 3C1. Just to be clear, 3C1 is typically for other passive investments. So if you're going to raise capital for other people exclusively, you're going to go 3C1. More than likely. 3C5, you guys, this is different. 3C5, this is really built for operators. It's built for people that are going to go and buy their own real estate and invest in their own real estate. Now, there's no limit to the number of people in a 3C5 fund. You could have 1 billion people in there, right? No big deal. Now, remember, you've got to follow 506B, 506C as well, and then these rules on top of it in a fund. But if you go into 3C5, this is specifically built for real estate. There's some rules here. So the first rule is 80% of the capital that you've raised has to be deployed into either real estate or mortgages. Okay, because it's a real estate fund. And 55% of the investments of the real estate, you've got to be in direct control.
Question.
Go ahead.
So if that fund is directly for real estate only, why wouldn't you just open up another fund, open up a different fund that you could invest anything into? And if you happen to just have real estate only in that fund, that's just what happens. Why would you want a fund specifically designed for real estate if you could just go to another fund that can hold anything?
Well, good question. The answer is, I told you 80% of the assets must be in real estate, right? The last 20% can be in whatever you want. Okay. So, Casey, let me tell you what I did. I have a 3C5 fund that is 506C. I can only work with accredited investors, and I have to make sure that I'm putting my own assets into this deal or into this fund as regularly as possible. And I look for an opportunity for me to co-GP as often as possible. That last one's pretty rare, right? Don't see that very often. But whenever I'm raising capital on a deal, if I'm going to raise a big chunk, I always ask the question, Is it possible for me to get 1% even on the GP so I can helps keep this fund in balance? So I'm constantly looking for ways to make sure this fund stays in balance. And you've got to monitor those rules. Now, your other question was why? We're going to get to that in just a second. There's a big reason why. A big reason why.
Okay.
Especially if you live in Hawaii. He's not here, but he'll watch the recording. Okay. So 3C5, right? Again, real estate primarily focused. Any other questions on 3C1 versus 3C5, friends? Great. All right, Casey, you ready? Exempt
I
reporting
was holding my
advice.
thumb up.
This is your reason, Casey. I thoroughly expect to spend the majority of the time of this presentation on this slide. So there's this rule, okay, called the exempt reporting advisor. And we have some challenges here, okay? If you have under $25 million in your fund, you're prohibited from registering your fund on a federal level, okay, in the RIA world. So anything under 25 million, now you fall under the state rules, okay? And the states have really three different categories of the way they break these rules down, okay? The first category here, full registration required. What does that mean? That means that there are no exemptions for 3C1 funds. If you start a 3C1 fund and you live in any of these states, okay, you've got to become a registered investment advisor. You've got to go and take the Series 65 or the Series 66 exam. You've got to fill out the IAD form, and you become an RIA. Pretty simple. I mean, not simple, but it's pretty clear. Becoming an RIA is super hard, just so we're clear. The second one is the truncated reporting system. This is just a notice filing. Basically, it's just you're telling the state, hey, I'm doing this. And, there might be a fee, $100 to $1,000. I mean, I don't know, right? I don't know the fees in the States, but they're not outrageous. They're not like tens of thousands. They're somewhere between 100 and 1,000, somewhere in that range. But sometimes you have to do it every year. Okay. And then there's a few other states, right? Down here at the bottom, self-executing exemptions, Florida, New York, Illinois, New Jersey, and Georgia. They just don't care. As long as you're under the 25 million mark, whatever goes. Okay. Now, once you reach the 25 million mark, you can register federally and you can bypass all of these state rules, but that's going to still require you to become an RIA and take the Series 65. So it's a can, not a have to. But when you reach 100 million, you have to register federally. Okay. So, yes, my goal for my fund, I'm not there yet because I'm not bragging. My goal is to raise $36 million a year. Okay. If I was doing that in 3 years, I would have to register as a federal registered investment advisor. So you just got to understand that. Exempt reporting advisor, John. ERA stands for exempt reporting advisor. Okay. So there's a lot to know here, and why can't I? Apparently, I can't copy these links for some reason. I was going to put these links in the chat. I'll figure out a way to get them. I'll get them posted where the replay is in Money Mental. But this nasaa.org site it's a national organization of state regulators, and you can find your local state, the official state rules right here. Okay. And then this Strictly Business, this is actually an attorney's blog that I found this on, and it's I went and looked at like eight different attorneys' websites to see this, and this was the one that I thought was the best. And again, I'm sorry I can't copy and paste for some reason, but I'll make sure that that's posted where the replay is posted. And what it is it's a list of all the states and a snapshot of what their rules are around this. And so you've got to understand what your state's rules are. Hey, Kendall, good to see you. Thanks for joining us.
Yeah, good to see you too. I had a question with these the registry. So if you raise, I know like if you raise in a different states, you have to register with each state. Is that the same? So like do like if you get an investor in Alabama or Hawaii, even though the
Yeah.
fund is not there, do you still got to be a registered advisor to raise in that state? How like kind of break that down for us, please. Or
Yeah,
me.
great. I'm glad you were going to that. So there's a lot of things to consider here, Kendall. The first thing is, where do you live? You got to consider that. Like, you might live in, say, Utah, right? But second thing is where is your fund entity registered? If you register it in Delaware, that's something to consider, right? But then where is your office located, right? Now your office maybe is located in Idaho. But then the last one is what you just asked about, Kendall, is where are the majority of your clients? If a large percentage of your clients are centered in one state, I would definitely pay attention to that state's rules for sure. Yeah, it's definitely a thing that you've got to pay attention to.
So what I'm hearing is like if you're in four different states, you have your fund in one state, you live in one state, and your investors is in one state, and your office is in another. Really pay attention to where your investors are and versus where the fund is located. Am I hearing that correct? That
Yes,
should be number one. Okay.
and this is 100% a conversation you need to have with your securities attorney when you're launching a fund, right? My favorite securities attorney. Well, I don't know if it's appropriate to call out people and names at this point, but the person I like the most, right, is the kind of guy that can sit down with you and just have a conversation with you about it, right? But those are the things that you've got to have. Where do you live? Where's your fund registered? Where's your office? And where are the majority of your clients? If you can know that ahead of time when you're having the conversation with your securities attorney, they can really guide you through that process. The reason I bring that up, maybe you live in Idaho and your office is in Utah, right? There's a few people on this call that I know that live in towns that are really close to a state border. And I don't know if you can tell by this, but I'm the kind of guy that drives a little over the speed limit, if you get what I'm saying. Right? And so rents an office in another state, maybe. I don't know, right? Like if there's some ways around it, is my point. Now, if you live in Hawaii, that's going to be tough, right? But there are ways around it. You just gotta know the questions to ask your attorney. Let me just skim my notes here, see if there's anything I missed. Any other questions while I'm looking through this?
I don't see anything in the chat right now, but if you have questions, put them in the chat. Let me
got a
know
question.
and raise your hand.
Speaking of the chat, awesome job, Chris. Put the links in there. Good. Thank you. Thank you, Chris. I appreciate you putting those links in there.
Yeah, my pleasure.
Yeah, I would definitely look at that strictly business law. That Kindle will answer those questions for you, right? If you go and if you answer those four questions, where do you live? Where's your office? What state you're going to register your entity in, and where are the most of your clients? Go and find those states on that list. It'll really, really help you understand this. All right. One
Question.
more.
I got a question.
Okay, great.
Sorry. This might be a dumb question, but so if you want to stay under federal radar, why don't you just have multiple funds of 25 million? Is it because, or 25 million or less? Is it because it's expensive to start funds, or is there another reason for that?
Remember this integration warning I told you about a second ago, Casey?
Okay. Yeah.
So
Never mind.
if you run multiple funds with the same strategy and the same, I mean, if they're inherently the same thing, right? They're going to integrate them. So now you could, Casey, if you wanted to, you could have a fund that is only for, say, oil and gas, and then a fund that is only for doing condo conversions, right? And then a fund that is only for, buying Airbnbs. But starting one of these funds, depending on, I mean, if you really, really, really cheap it out, you might be able to get it done for 15 grand. Maybe.
Okay. That makes sense.
But good question. I mean, that's not a dumb question. I mean, it's really not. I agree. Like, we want to find, I go back to the conversations about taxes, right? And everybody says that the taxes are just a game, and they have a rule book that's this tall off the floor, right? And as long as you understand the rules, you can win the game. Same thing here, right? You're just trying to find a way to accomplish your goals without ending up in an orange jumpsuit. Great question. All right. Now this is a fun conversation. And I have to admit to you, when I was doing the research on this, I didn't realize how big a deal this is. I think everybody on here knows what an IRA is, right? Is there anybody on here that doesn't know what a self-directed IRA is? Okay, good. So when you, there's this big rule, right? The 25% ERISA rule. So if your fund accepts any kind of retirement income, any kind of US retirement income, self-directed IRAs, solo 401ks, retirement plans, anything like that. The short answer to this rule is you've got to monitor that you never hit 25% of the money in your fund in retirement funds. If you do, you become an ERISA reporting advisor.
Wow.
Now, every single year, you have to have a third-party audit on your fund. Every year. And there's new reporting requirements that you have to do. A bunch of hoops that you have to jump through. And a bunch more rules. You legally become a fiduciary advisor. And what that means is when you're legally a fiduciary, you have to, by law, put your client's interests above yours by law.
Yeah, you have to do that anyway.
Well, but it's different, John.
Sorry, I thought I was on mute.
No, you're good. You're good. You should do it now. Okay. That is something every single person on here should do. But when you're a reporting advisor, you have to document it. You have to prove that you are putting your people's interests above theirs. And you have to disclose everything. When I was in this world, when I was in the fiduciary world, so I was a registered investment advisor for over 10 years. Like, I lived this world. This is what I did for a living. And when I did that, I had to file what's called an OBA, outside business activity, for every single business that I did to make sure that there was no conflict of interest. And I had to file one for every business my wife did. She became a Mary Kay rep, selling makeup, but it's technically an MLM. And we didn't fill out this OBA. And it cost me $1,000 fine for her to become a Mary Kay rep. And all she was doing was trying to get the discount on Mary Kay. So when you step into this world, it just becomes such a different, the rules just become different. Okay. So how do you avoid this? Well, 24.9%. That's the magic number. I'm actually going to go and rebuild my equity tracker to actually show this. I probably shouldn't say this on a recording, but I'm going to. Today, I have no idea. I don't know if I'm at 10% or 15%. I'm confident I'm not at 25, but I don't know. I don't know how much I have in self-directed IRAs as far as a percentage goes inside of this fund. And so that would be my recommendation, is figure out a way to track the amount of capital that you have and what is coming from a retirement fund, and make sure that it's never over that 24.9%.
I have to say thank you for this, because I hear so many people say self-directed IRA, use your self-directed IRA. I go to meetings all the time and everybody's like, you could just invest your self-directed IRA, but they don't know this 25% rule, and I didn't either. So this is like the gym I'm taking and I'm gonna run with. This is crazy, but I also want to know, did you tell your wife to go sell some of that Mary Kay to get that $1,000 that you lost? We start selling
Oh,
now.
no, I didn't. I should have, though. I should have. She actually might be on this call. I wonder if she has any comment on it. No, she uses Mary Kay. We got it for the discount. Some of those MLM companies, there's some steep discounts if you become a rep. So, anyway. Okay. I just want to pause here for a minute. Thanks for pointing that out, Kendall. This is a big deal. Really, I've given you 3 new things that I expect most people probably don't know about, right? This 25% ERISA rule, the exempt reporting advisor speed bump, and 3C1 versus 3C5. You guys, these are pretty deep concepts. Anybody have any questions about them? Do we need to talk about them? Examples?
I was just curious if ERISA, is that an acronym for something?
Yeah. I have no idea. It's the name of the bill. I'm looking at my notes.
While you looking, I think the R might be retirement, and at the end, the A may be accounts.
Oh, you're probably right.
But I don't know what the rest mean. But yeah. But I did have a question when you was talking about the 9C, I think it is, where you was talking about like basically buying real estate, and 80% has to be in real estate, 55 has to be in like active real estate. So the other 20 can be in like stocks and bonds or business. It could be in anything else, or is there a certain rule of what that 20% can be in?
Yeah, great. Yeah, no rules. Well, no, the rules are defined by your PPM, by your fund
PPM.
documents.
Okay.
Yeah, so the rules are, again, 80% has to be real estate or mortgages. That the other 20% can be in virtually anything, right? As long as it's legal, ethical, and moral to be invested in the United States, right? I've got oil and gas in mine. I've got some businesses in mine. I've got some debt in mine, all sorts of things in mine. And then the other rule is you need to be in control of 55% of the real estate. Okay, good question.
Thanks.
Yeah. All right, friends. Key takeaways here. I really want you to get, the most important thing is you've got to understand the rules. You don't have to be an expert, but you've got to know the questions to ask, right? This is not something that the average person can do on their own. I mean, I am not an expert by any means, and I have spent hundreds of hours probably studying these rules over the last 15 years. And I still use an attorney every time I do something like this. You've got to choose the right structure that fits your business strategy. So you've got to know your business strategy, right? Do you have this really strong pool of investors that you already know, so you don't ever have to worry about advertising? Do you want to only do securities? Then you go 3C1. Are you also an operator and buying your own deals? Then maybe you can get away with 3C5, right? But the thing that I really want you to remember is compliance is the most important thing, okay? Because I'll bet Rebecca would look good in orange, but she's probably the only one. Okay, so that's what I have for you on that, right? But next week, I'm really excited about next week because I'm going to show you how to make some money, the actual financial engineering of this. We're going to revisit how much money we're going to make or could make potentially. And I'm going to give you a 14-day launch plan blueprint. Couldn't get that word out. So I'm pretty excited for next week. But we've had a lot of people, friends, that have asked us to make this, to go a little deeper with this. So, Chris, are we ready to announce our next level of this venture?
Announce away, Senate.
Awesome. Hold on. I am so excited, you guys, to announce the Money Mental Fund Lab. Starting September 1st, so 6 weeks-ish from now, Chris and I are going to launch an 8-week done with you fund lab. The promise here is at the end of 8 weeks, you have a fund that is spun up, legally compliant, that fits your strategy, that is ready to accept capital and deploy capital. There'll be deal sources for you. There'll be some marketing training. I mean, just so we're clear, this is not a capital raising training. This is to launch your fund. Okay. And it's not even a training. What it is I'm going to act as your fund launch concierge. Okay. So we have a million steps, right? And we're going to condense this all the way down into like 10 steps for you. And then we're going to link you up with all these other people. And on top of that, it comes with the mental fortitude training that Chris Schwagel offers to his Money Mental community. So you're going to get this 8-week cohort, this fund lab, and then 14 months total of Money Mental along with it. Pretty darn good deal. Okay. Now, those of you that are interested in it, this is the website that you can peruse the website and share it with your friends. Talks about everything that we have that's covered, the problem, the vision that we have for you, a little bit about me, a little bit about what we're going to do, and what's included. Now, because I want to talk to you about the process, because doing this it takes a lot to launch one of these things. And so we can't just let just anybody in, right, to this cohort. We want to work with people that are dedicated, that are committed. Okay, so we only have room for 12 to 15 people. So there's actually going to be an application process. And we're going to accept people into this program. So they basically have to interview with Chris or I to qualify. And part of the reason is because we only want to work with people that are actually going to launch this. And our rate that we're going to charge for this is fairly small, honestly, in my opinion. Like I've had multiple people tell me that we should double the price. Multiple people. But the problem is there's a lot of other things that people are going to have to pay for. Launching a fund like this is probably going to cost you $30,000, maybe $40,000. You've got to have that kind of money liquid and ready to go. Which makes our $7,500 seem pretty small. Right? So you're going to pay Chris and I $7,497. That comes with 14 months of Money Mental plus this cohort. But then on top of that, there's a fee the attorney's going to have. There's a fee the portal's going to have. I'm going to connect you with a co-op of fund managers that are going to bring you deal flow and help you with due diligence. And there's a marketing solution on top of that that's got to come too, right? And all of those other things have expenses. So I just got to make sure that we're clear. It's not $7,500 and you have the fund. It's $7,500 plus these other things. So, does that sound exciting, friends?
I just want to say I appreciate keep I appreciate that, like what you're saying in the that's when you're going into this, there's going to be more expenses as you're building your funds. I've done other things in the past. Um, I've done other things in the past, and they're like, yeah, it costs this much to join. And then next thing you know, it's like, oh, you got to do this, 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 and this. It's like, what the heck? It wasn't just the price of the thing, it was everything else. So I appreciate you letting us know, like, there's going to be more on top of that. So thank you for that.
You're welcome, Casey. And just to be clear, the reason we're doing this is because the number one KPI that Chris and I decided on was successful fund launches, right? So if we have 15 people in this group, I want to have 15 fund launches, right? If 15 people join, 15 people leave with a fund. And so I don't want there to be any surprises for these people. And when they come in, I want them to be successful.
So I want to ask on that as yeah. So one of my partners is on this call. He's been sitting silent the whole time. He's just kind of in the background. My brother actually. Uh, so him and I are both doing this thing together. So would it be the price of the class times two, or do we, if we both get in and we both join, is it the same price? Is it the 74.97?
Okay. I'm going to ask this question. This is the way to answer that question. When you launch your fund, are you going to be partners in the fund, or are you both going to launch your own fund?
As of right now, we'd be partners in the fund.
Yeah. So when you go through the interview, I'm going to tell you that answer would not get you accepted to the cohort. Because there wasn't enough confidence in it, Casey. We're partners. We're going to launch a fund together. We're going to do this in 8 weeks. That's what I need to hear. Not, yeah, as of right now, I think we'll be partners. No, it's, okay, are you and your brother actually going to launch a fund together? Combined, do you have approximately $50,000? And are you willing to make this investment? If you answer yes to those questions, I'm going to say it's one fee. But see, that's the thing. I'm looking for conviction. I'm looking for confidence. What I don't want is to work with somebody for 3 weeks, and when they actually only 2 weeks, and when they see that they need to write a check to Byron Elliott for $10,000, and then they get cold feet, right? They get butterflies. Their heart sinks, and they don't want to do that. Or when I say, okay, now you've got to write a check to Avester for $10,000, they write that check, right? And then when I say, okay, now you got to join Connected Capital, and that's $6,000, they're going to join it. Because these are the things that you have to be successful in this business. I've done this now. I've raised capital 51 times. I'm not the best capital raiser out here, but I know what you have to be successful in this business. Okay. And if you're not going to buy the whole package, you shouldn't buy any of the package.
Are there a lot of fund managers who do this alone? I feel like there'd be a lot of partnerships when you're building a fund.
Yeah, I mean, Casey, you and I've talked a lot about my 3.5 rules of partnerships, right? So if I'm very cautious when somebody says they're going to have a partner, I always question that, right? Have you done business together? I mean, it's your brother, you know the guy, right? So I'm not worried about that. But unless you already have an established relationship, you shouldn't just come together with somebody to build one of these funds. It'll blow up. I literally know 5 people that have launched a customizable fund like this with a partner, and after their first capital raise, they shut down their fund. 5. Because they thought that exact thing. It was like, Casey, I've got this friend that was in my same, this architect friend that was in the same mentorship as me, right? So we're going to come into a fund together. No, man, you've got to really vet the person. These funds, you guys, syndications usually run 3 to 5 years. Okay. And so, if I go and partner with you on a co-GP on an apartment building in Nevada, Casey, we're going to be in business together for 3 to 5 years. Okay. And it's one deal. It's not very complicated. But these flexible funds, right? I mean, I have 14 deals in my fund today, and it's just me in my fund, right? But in 10 years, right? If I do 8 deals a year, I'm going to be over 100 deals in my fund. And then I've got to run my fund throughout the length of those syndications. So I've got to run it for at least another 5 years after I quote unquote retire. So this is like a 15-year business venture most of the time. I mean, it doesn't have to be. Like we talked about earlier, you can have funds for any kind of strategy you want. You could only keep it open for 2 years if you wanted to. But most of these people, right, you're going to start one of these funds and you're going to be in business for 10 to 15 years. Right? You're going to ramp up, capital raise, and you got to be operating all the whole through this time. And then you're going to operate for a while, and then you got to shut down. I don't know. John, what do you think? You've been in this business a long time. Is it 10 or 15 years?
So it is definitely a long time. I do disagree. I would agree that it's multiple years. I don't plan on shutting our fund down, right? I mean, part of our business model is Cindy and I are going to retire in 2 years, and the fund will continue because of the infrastructure we're building.
Yeah.
So
So in that case, it's good to have partners, right?
yeah, yeah, I definitely like the partnership. I'm in a terrible partnership right now that kind of like I wish I could claw my eyes out. Um, and I'm in a great partnership. So it is really it can be great. I love like on like I've had 6 sets of partners and 2 have been bad and 4 have been outstanding.
Nice. That's pretty
Hey,
good.
John, I wanted to say, like, I don't even call them partnerships. I call them marriages. Like,
Yeah.
I'm married to this person and I have to go through court to divorce this person if something goes bad. Because when you say partnership, sometimes you could just walk away depending on how the project is set up. But when you say marriage, that's how I look at these syndications as we're married to each other.
Yeah.
And it's not easy to walk away.
Yeah. I think Kendall, absolutely. That's how I'm looking at our the rough partnership that I'm in right now. It's still amicable. It's just not enjoyable, right? So
Sure. Yeah,
yeah.
I'm not beating up on partnerships, you guys. Sometimes they're amazing. And let
Mhm.
me tell you, like, I mean, Chris and I have just barely started formalizing our partnership on this, and it's amazing. I mean, he's pushing me in ways that I would never push myself, and he's giving me insight, and it's absolutely phenomenal. And when I buy my own deals in Idaho, I partner with a guy named Chris Carney, and he is absolutely the most amazing operator I've ever worked with. So there are good people out there and good partnerships.
Yeah.
Anyway,
A lot of times I see partnerships coming together to going back to Casey's original question of splitting costs,
mhm.
right? That's why I see a lot of partnerships get created. That's why I created my partnership with Jeff and Dale, so we could split those costs. And that
Yeah,
was not a good decision.
right. No,
We
exact
partnered out of necessity, not because it was a good business decision.
and that's John. That's why I answered the question the way I answered it. Right. If you're going to partner on your fund, you can partner on this. But if you're going to come into this and do 2 funds, it's 2 fees.
Yeah. Yeah. Yep.
And I
Awesome. You
think
guys, we
Senate is
had
fired up about this, if I could interject, because we talked about this. The only goal of this cohort is 100% of people are going to launch a fund. And that's why we're not doing a roadmap. That's why it's not a, hey, here's a blueprint, do what you want. Senate's going to be spending 3 hours a week with people in this cohort. That's a lot of concierging. That's a lot of hand holding. That's a lot of fill this out. You'll need to know this. Think ahead to this. What do you want to do here? A lot of playbooks that he is helping people implement. So I love that Senna got fired up to that answer because he's playing all in on this for sure. And that was fun to see.
Thanks, Chris. Now we're excited. We're going to launch 15 funds. So what other questions do you guys have? Anything else while we're together?
You mentioned 10 grand for Byron, 10 grand for a Vester. What are the other expenses that we need to budget for?
Yeah. So I haven't actually gone and made the complete list yet, John. But the attorney, approximately 10 grand. You've got approximately 10 grand for the portal. You've got approximately 6 grand for connected capital, right?
Okay.
It's not required, but if you're going to follow my system, you need to follow my system, right? So here we are. That's about 26,000. Okay.
Yep.
And then we're still figuring out the marketing solution, right? So we don't know yet what that fee is going to be. So we got to figure that out. But I'm also going to add up what the monthly fees are going forward, right? So like Avester has, it's $600 a month after that to be on Avester, right? So what's 600 times 12, $7,200. So I'm going to add that into the total, right? So this is your first year of expenses.
Well, and to kind of talk this through a little bit, you're saying 35-ish grand all in.
Yeah.
So I don't know if anybody knows Senate and I's history, but Senate and I spent $25,000 for Raise Masters, and then 15,000 for lawyers, and then 15,000 for websites, and then right. So uh, this is a bargain. Like I mean, serious. This is 30% of what it would normally cost.
Yeah.
I spent $125,000 to get my business set up, and you're doing it for 35. Like
Roughly.
that's pretty outstanding.
Yeah. And thank you for that, John. That edifies and reinforces everything that Chris and I put together. Thank you. To that point, right? I've had multiple people tell me that this price is too low, right? And so, this first one we're going to commit to this price, and if it's really successful, maybe cohort number 2, maybe that price goes up a little bit, right? But I don't want to gouge people, right? I want to serve and support people and make sure that we're doing something good, right? And I just want to help them out. And so we're trying to do everything we can to get this done right, but as economically as possible.
Love it. Congrats, man.
I'm just curious how you have time for this, Senate. I know some of the projects you're doing, not all of them, but I know some of the stuff you do. And it's like, how do you have time? I don't get it, but the fact that you can find it, good job.
Well, Casey, I appreciate that. Thank you. Thank you. Chris, can we talk about the affiliate program?
I think let's stick with Money Mental people for that. We can have a
Okay.
private program or private
Perfect.
conversation about that. Yeah. Senate, thank you so much for this today. I had some aha moments and was jotting down a ton of notes. And I know that you learned a lot in this process of putting today together. So I can't imagine how much other people got out of this because I haven't done 51 deals. And so this is really, really valuable stuff. And in the chat, there was a lot of shout outs to you about like, hey man, thank you. And I'm sure we'll send this out to people right away in the replay and get people here next week for the conclusion of the Fund of Funds 14-day launch. Excited about that. Thank you so much for everybody for being here live. We really appreciate that. And Senate, thank you for putting this all together and being our guide. We appreciate it.
You're very welcome. Thanks, everybody.